Alrighty guys, so let's begin. Now for those of you who haven't been in a webinar with me, I like to be interrupted. I like to answer questions right away, then wait till the end. So please don't hesitate to ask some questions, even if I'm in the middle of a sentence. I don't mind. It's better to, I believe the method is that if you have a question, then it's best to get the answer right away, so that way you'll remember more vividly the reason why you asked the question in the first place. Besides that, please guys, feel free to talk up, chat up, whatever it is. We're here to just learn and have some fun all the while. So today we're going to go over chart pattern additions, okay? Now, the benefits of combining factors. This is really what this webinar is all about. And what we mean by combining factors is basically taking the good with the bad and putting it on a scale. If I were to take a scale and I were to look at a trade and say, hey, I want to get in long, then you should ask yourself, okay, why do you want to get in long? What is telling you to get in long? And then what you should be doing is taking every little bit, every little nuance that you see and put it on the positive scale, on the con, on the pro side, right? And then you go, all right, now how about if I was short? What would I like? And then whatever you think you like as short would be the best thing for the cons for your direction. And then what you do is you add them up, you sum them up, and you go, all right, I have 50% good things about this move, and I have 50 things that are showing bad things about this move. With that being said, would you want to get into that position? Anybody have an answer for that besides Peter? Peter's a member, so yeah. No, right? Because basically if 50% looks like it's going your way and 50% is going the other way, then that's probably going to create a divergent pattern, and divergence is choppiness, okay? So a couple things you need to know in order to take advantage of combining factors. And if you don't understand these simple practical measures, then it's going to be very hard to be able to be consistent. I'm not going to say you're not going to have winners and losers regardless, but you're going to be consistent, and that's what you want to get. That's really much more than profitable, not consistently down, but consistently up. So works with laws of linearity, which we'll get in later. It allows you to see the overall, not late at all, Joanne, and also there it's recorded, so you know you got no worries. Welcome. So it allows you to see the overall direction of the stock, and this is important. I bet you many of you think that you know what the overall direction of the stock is, but in reality, really, how much do you really know about the overall direction? And by understanding the overall direction will better help you with the trades that you want to do. And it allows you to weigh the strength of the probability of a move. So the more factors you have on your side, the greater the probability that move is going to work. The less things or the more things you have going against your direction, then the less of a probability that move is gonna work out. Everyone following so far? And really, when you see all this put together and built brick by brick, you realize that it actually helps with confidence in the trade, because you're not just getting in for some baseless reason. Instead, you have combining factors that are giving you more than enough reasons that this may be the right move. Okay, and because of that, because you see all those nuances that are moving in your direction, you feel better about the trade, regardless if it works or it doesn't work. Okay, and like I said before, it provides you with a higher probability setup, so you're able. You know, it's a good thought to think about it this way. If someone was offering out in the internet a way to increase your probability by doing one thing, would you guys do it all the time? I would think so, right? And for that matter, what I'm trying to build here, okay, good. So if what I'm trying to build here is if you have enough data, okay, that is moving in your direction, then you already know how to find higher probability setups. How? By combining more. The ones that have a lot of sequences that are happening simultaneously will work out much stronger than ones that don't have as much. Okay, and this is actually a real important part. Last two could help with building foreshadowing. And the foreshadowing effect is basically very important as well. It's one of the 5 laws of the markets that we teach. And laws of foreshadowing basically teach you how to look at the wider time frames to know what may be coming soon on the shorter time frames. Anyone have any questions on that? You look at the wider time frame to see if anything may be forming for the shorter time frames. Okay, good. So anybody, like I said, please ask your questions. If you don't ask your questions, then you're not going to be able to catch me on a recording. And this will help you increase your consistency and limit fake outs. And one thing that I'm going to add, I think we have it out a lot in YouTube and stuff of that nature. So I'm actually going to teach you guys one of our first setups, which is called the market structure pattern. Okay, and this is a very powerful reversal pattern. And if you study it, you acclimate with it, and include and factor in other setups that are forming to build your direction, then you're going to have a lot of success with this setup. So law of linearity. Laws of linearity basically mean that any price action that happens on the 1 minute will equally happen the same way on any other time frame. So to go deeper into this, if you have someone, you know what? Let's try to get some people in here to talk. What's your favorite chart pattern? Someone give me their favorite chart pattern. Anybody? Nobody has a favorite chart pattern? Okay, so let's say, okay, here, someone's typing here. Okay, so you see a bull flag. Now let me ask you, or a head and shoulder. If you see a bull flag on the 5 minute, or a hammer, or a head and shoulders, do you think it will work the same way on a daily chart if you saw it on the daily chart? Yes, exactly. It is scalable. And this is one of the most important, most important nuances you really have to become familiar with, okay? Because this really brings to light everything you're going to need to know in order to put everything together. This is like the glue of the whole strategy. This and foreshadowing. So that tells me that if I could find a cup and handle on a 1 minute, then I could find a cup and handle on the hour and trade that too. And even more so, that means I could find a cup and handle on the 5 minute. I could find a bull flag on the daily happening at the same time. Now, what do you think is going to happen? Do you think you have a greater chance if you have 2 chart patterns forming on 2 different time frames simultaneously? Do you think that's going to increase or decrease your odds of having that as confidence increase? Good. So that will definitely boost your probability of it working out. And this is basically what laws of linearity are trying to say, is that any setup, any strategy you guys do, if it works off of price action, then it's scalable. Okay? And if it's scalable, you could also look deeper into the market and look for very big moves that most people don't even see, which I'm not really going to get into. That's not really the goal here. It's more about just using your own setups that you guys have and using chart patterns together. Okay? But we'll use the market structure high as an example. So the only difference between a cup and handle on the 1 minute and a cup and handle on the daily is what, guys? What's the only difference? If you were to trade the 1 minute cup and handle or the hourly cup and handle, what are the differences? Time, good, very nice. And lastly, there's one more. Gotta take a sip. Price range. Time and price range. Okay? Force behind move. You should watch my other webinar, Hardik. You'll understand how to find the force behind the move. Or maybe you'll understand it here. Who knows? But it's time and price range, right? 1 minute in a sequence of one oscillation will probably give you, let's say, 20 cents, while hourly one oscillation could give you $1. Okay? So you have to understand that it's the price range and the time. Those are the only differences. Yeah, that goes more deeper into risk and probability, which we teach as well. So candlestick and chart patterns. Now, many of you know these setups. It doesn't matter. That's not the goal here. The goal here is just to prove to you how adding multiple chart patterns and strategies that you guys may have yourself to increase your odds and your consistency. So one pattern won't do much, right? But two patterns will definitely give stronger sentiment to your direction. 3, 4, and 5 even more so. By finding multiple candlesticks and chart patterns in multiple time frames, it'll only increase the probability of the move. This enables a trader to take advantage of a domino effect that occurs in multiple time frames of charts, which we'll get into more later. And we'll go over some basic patterns that you may or may not know. So, engulfing candles, doji candles, and Harami candles. And there's actually a very good reason why I'm going over these two candle sequences, guys. All right? Does anybody know these candle sequences? All right. These sequences are often components that overlap with larger patterns, so it's good to be familiar with interchangeable components of 2 and 3 candle sequences. All right. So an engulfing candle is a 2 candle reversal sequence where the first candle is the same color as the trend, and the second candle is the opposite color. The second candle body should be larger than the first candle body at the open and the close, thereby completely engulfing the first candle. And a lot of people confuse this. Does that mean engulfing the wicks as well, or only the body? What do you guys have to do? There's some people typing, guys. Okay, body. Okay. So, this represents a dramatic change in sentiment as the second candle opens in the direction of the trend, but takes a hard reversal to close beyond the prior candles open against the trend. Now, I think I have the ability to draw, so hang on with me, guys. Bear with me here. So, now, a bullish engulfing is going to have an uptrend or a downtrend prior. Anybody know that? Down. Good. So you're going to have a downtrend. Okay, you're going to have a bunch of candles. Right? I'm not going to change the colors, right? You get that thin candle because it's getting tired. And what happens is it opens up low. Right? Opens up low, covers all the way, and is the opposite color of the red. Right? Obviously, this would be red. Okay? And this would be green. Okay? And at that point, once it closes above, there goes your engulfing candle. All right, now let's see how we delete this. That's the question. I'll just click back. Is there a way to click back? There you go. So that's the engulfing candle. Harami candle is actually very simple. it can also be called a pregnant lady. And the reason why it's called a pregnant lady, because it's the same thing as an engulfing candle, just vice versa. Instead of the second candle engulfing the prior candle, it's the first candle engulfing the next candle. Okay? And this also gives a sentiment of a reversal, the same way, after a downtrend or after an uptrend. Alright? And that's actually a bearish Harami cross because it's a doji included inside of the candle. Okay, so don't be mistaken that when it's a doji, it's a Harami cross. It's not just a regular Harami. That could definitely help with the sentiment. Now, a lot of people don't know everything about the hammer. So I actually want to see, we have 40 people in here. I want to see how many people know everything about a hammer. Now, does a hammer happen after an uptrend or a downtrend? Only downtrend, Hardik. And what color does the hammer have to be? Any color. Good, good, good. And is there any other confirmation that you need after that? It should be actually the next candle should close above the hammer. Yeah. Okay. You must have that next candle close above the hammer before you even decide to take a reversal. Okay, guys? And it's only after a downtrend. And a shooting star is the opposite. It happens after an uptrend. Could be any color, but the next candle has to close below the shooting star candle. Everyone with me so far? So, an example of a multi-pattern. Now, many of you probably only trade with 1 or 2 time frames. However, in our strategy, we teach you to trade many time frames. Okay, so you're going to be trading the 1 minute, the 5 minute, the 15 minute, the 60 minute, and the daily. Really just all the way to the 60 for intraday, but you usually bring the daily in as well. However, if you're swinging, then you would go all the way to the weekly and monthly. And by looking at all the time frames at the same time will give you a much better outlook. It will allow you to put the stock under a microscope and try to figure out what really is moving this stock. Okay? Is it going to move up or is it going to move down? And what would tell me it's going to move up and what would tell me it's going to move down? These are all little nuances that you guys are going to have to try to build. Unless you take Alpha 7 course, of course. So the first setup, okay, is an ascending triangle. You guys see it? Can anybody see another chart pattern here on the weekly or monthly? Anybody? See any chart patterns? I'll give you guys a minute. Hammer on weekly, okay. I don't know if it closed above the hammer. I can't zoom in here since I'm sharing it, but it looks like it may have closed above. I wouldn't be able to know, but it could be either way. Should I move on to the next chart pattern that's going to show? All right, we have a cup and handle. Does everyone see that? On the monthly. No problem, but this could be used more than just for candlesticks. It could be used for your strategy. So what's happening here is that the 1 minute and the monthly, even though, the daily and the monthly are completely separate time frames. However, they both break out of their resistance at the same time. Okay? So by them breaking out simultaneously, it allows you to take the move with more confidence and with a greater move. All right? Any questions on this? All right. Lastly, you still have another ascending triangle here. So now I'm going to go into the good stuff. And hedge guy, if you didn't leave yet, I don't know if you left or not. You just left right before I was going to teach one of the strategies. Okay, so market structures. They are a special 3-candle sequence setup. Sorry for the P missing. Markets form internal, often hidden price structures. Market structure concept was developed by Dr. Russell Lockhart. Now, these powerful reversal points in which chart and candle patterns can be combined to increase the probability works very well. And this is how it works. And it works on all time frames, okay? But obviously, the earliest predictor will be what, guys? The 1 minute, and the latest predictor will be the monthly, okay? It follows laws of linearity. So now, with that being said, a market structure high is a reversal pattern for a short. And a market structure low is a reversal pattern for a long. And I suggest you guys ask the questions here, because this is a good freebie. And what it consists of is a new high, a higher high, and a lower high. So if I were to draw some candles here, all right, let's just make it green. All right, if I were to draw some candles, and let's say this was the low, all right, and this is becoming the high. Now that's the high, okay? Now, the 3-candle sequence starts like this, guys. You have the new high, okay, and then you have the higher high. Everyone following me so far? Any questions? Okay, and then you have the lower high. And the reason why it's the lower high is because it has not touched higher than this price right here. And at this point, okay, guys, at this point, when this candle closes, you get in once the price breaks below the bottom, the low of that candle. A tick below the lower low, okay, or the lower high. A tick below the lower high. And not only do you need that, but you also need stochastics, okay? You need the stochastics to cross down. Okay, and at that moment, if you have the stochastics crossing down and you have the 3-candle sequence, you may have caught yourself a nice reversal. Any questions so far? It seems simple, but when you actually try to put it into effect, it takes time to get acclimated to. And for a market structure low, would be a reversal for a high. You're going to have candle, candle, new low, new low, new low, higher low, and then higher low. Okay? So here's your new low, lower low, higher low. You get in right here, and what do stochastics do? What should they be doing? At that moment, what should they be doing? Crossing up. All right? So when you have the price break out and the stochastics cross up, this is your entry. Now, your stops are once it breaks again the lower low, because then it's not a reversal anymore, it's continuing its trend, its prior trend. Everyone understand that? Okay, so let's erase this stuff. Alright. So this is a better illustration here. Sequence of 3 periods, a high followed by a higher high, and then followed by a lower high. And the low of the third candle is the trigger. Okay? So, now this is a good way of testing you guys out. Since you guys cannot draw, tell me the approximate time where you see a market structure high or a market structure low. He was quick, Hardik. 11:45, 11:44, good. Very nice. Did the stochastics cross down? Okay. Now remember, this is important. Was this an actual new high? Because remember, you always need a new high before you could even start triggering the sequence. Yes, it was, right? Because the prior high was here. Okay? So right away, when this is a new high, it triggers the possibility of a market structure high forming. Then you got your higher high. Not only that, but it's not much of a shooting star, okay? Because it needs to be double the wick. But what I'm trying to pose here is that you should be looking for hammers or shooting stars, including with the market structure highs and lows. Okay, that's good. K period equals 15. D equals 5. Slow equals 3. You're welcome. Oh, that's the main goal. You mean you're not going to be able to find multiple setups that happen simultaneously on one time frame. That's why you have to use the power of looking at multiple time frames. So by looking at multiple time frames, just by seeing them being all in the same direction and moving up in the up direction, automatically should tell you that it's very strong throughout all time frames. Let me give you an example. Let's say the 1 minute, right, is trending down. The 5 minute is trending down. Okay? The 15 minute is trending down sideways. Okay? But the 60 is upwards. The daily is upwards. The weekly and monthly are upwards. So if you got the 1, 5, and 15 going down, but you got the 60 daily, weekly, and monthly going up, in due time, which direction do you think that stock or whatever you're looking at, what direction do you most likely think it's going to be taking the formation of? Up, right? Because remember one thing, the wider time frames hold the strongest undercurrents. Okay, since the wider time frames, each candle in a wider time frame holds a lot more data than a 1 minute candle. Okay, and for that reason, it holds a lot more weight. So because the wider time frames are still moving up strong, then the shorter time frames may converge into the wider time frames direction. And this is a very important concept to understand, because then you'll realize that by looking at by looking at multiple time frames, you're able to get a better sense of what the stock really wants to do. Does it really want to go up? Does it really want to go down? And let me give you an example. Let's say you're looking at one of your setups, a breakout for the 1 and 5 minute, and the 1 and the 5 minute are trending up. However, you don't look at the 15 minute, but the 15 minute is still trending down, and it's touching the 5 MA resistance. Do you think that's going to cause a problem for you to go up? Absolutely. Okay, because you still have on the 15 minute trying to push downwards. Overall direction is downwards. So even though the 1 and 5 are looking to go stronger, higher, you have to be very careful, because the 15 minute may push you back down. So what you want to do is try to align the direction of multiple time frames to work with you. All right. So Now this is another example of looking for multiple chart patterns. Now with everything you learned, can you guys find some things for me? The first one is already there, a hammer, right? You should want the time frames to have the same direction. Not all of them. You should at least have the 1, 5, and 15 for your direction. But if you're looking to swing, you would want a lot more on the wider time frame. Anything else, guys? What do you guys see? Let's say we have a hammer, right? Oh, great, we have a hammer, and the next one closed above the hammer. But is that what I really want to use to get into a trade? I would never get into a trade just for the sake of a hammer, guys. I want to let you know, okay? The point here isn't to make trades off of what I just taught you. It's how to add factors in so that way you could increase it. So I'm not going to just get in off the 1 minute hammer. I want some more evidence that this is going to go up. So what other evidence is here? Engulfing on the 5 minute. Stochastics. Think about what you guys learned. Think about what you learned. Look for a market structure high, market structure low. Well, I know what this, yeah, market structure low. There you go, Sheilinder. Very nice, Joe. He got it. Well, there is a market structure high in the 5 minute possibly. I don't know about the previous data, but I know this is low. Okay? And, so let's calculate it. This is the new low, that little small green candle. This is the lower low, and this is the higher low. Does everyone see that now? So we have a hammer on the 1 minute, and we have a market structure low forming on the 5 minute. Now, where's your entry on the market structure low, guys? Where would be the price? You guys could kind of calculate the price. It's right around a level number. Where would be your entry here? No. 7180s, guys. Remember, new low, lower low, higher low. If this is the higher low, where's your entry? Your entry is a tick above the higher low, correct? So that would be this candle right here. Whoopsie. Right here. Okay, which is 7180s. Does everyone see that now? Do you want me to clear it up and do that again so it's... There you go. See that? Okay, so, yes, very nice, Bruno. Later on, look what forms. You see, and that's foreshadowing, Bruno. Later on, and what foreshadowing helps is, when do I sell? How many times have you people sold and then it continues to go higher? And you go, damn, how could have I figured out it's going to go higher? How? Foreshadowing. The 5 and 15 continued to have a market structure low as well. Never broke its stop. And that allowed it to continue to go higher. Well, the 1 minute is just giving you the hammer. You would want to get in with the 5 minute. Or if you feel that you're anticipating and you already see the market structure low forming and you see the hammer, then you could go off the hammer on the 1 minute, basing it off the 5 minute setup. This way you get in a little bit earlier. And you would have gotten about 5 cents earlier. Right? And lastly, you had the stochastics cross up. Any questions on this slide, guys? Welcome. Yeah, it's recorded. Yep. Alright, so you'll see here the formation, the hammer. Oopsie. So there goes the market structure low showing over there. Alright, guys? And that's what I really wanted to go over. And right now you guys could really ask questions because we're pretty much done. So right now is the time to ask any remaining questions you have. Just remember that this could be used with your own setups, guys. Every one of you may have your own setups, your own trades. Try looking for them on multiple setups. Or at least for now, what you should do is look for one of your setups and then look at the wider time frames to see if they're even converging in your direction. And if they're converging in your direction, then at least you could say to yourself, all right, I got the 5-minute going up, I got the 15-minute going up, I got the moving averages going up. So my 1 minute should continue to go up with it. All right, it's not showing any direction against it. And maybe I'll do like a second episode of this, and we'll go a little bit deeper into it. I'll have to think about that one though. Okay, so what is the entry on the market structure high? A tick below the lower high. Yes, a tick below the lower high. So basically, boom, 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 and right here. Sometimes they look like middle fingers. Okay, but they got to be new highs, guys. And remember that if you're looking at the 1 minute, 5 minute, 15, or 60, every day a stock makes a new high and a new low for the day. Yeah. For breakouts, well, sometimes they do break out with the reversal. You catch the huge reversion. However, sometimes the market structure low will fail and will break out, try to break back out. At this point, you could try to take the reversal. And the reversal is your stop, right? So here is a new high. Here, let's make believe these are candlesticks, right? And then here's the trigger of the market structure high. Right, Sydney? Now as it goes down, you're thinking it's going to continue to go lower, but instead it pops back up. And at this point, you're going to start having that resistance. And it's your stop, right? So if you feel that it really made a fast reversion because it's decided it wants to go higher, then maybe instead of just plain old stopping out, you could reverse it for the move up. And that would be a breakout. This market structure high and market structure low are more reversals. Any other questions? All right, well, this is going to be recorded, guys. So if you can, just email support@alpha7trading.com if you didn't provide an email. If you didn't provide an email and you came in, you know, anonymously, then just email me here, put subject recording, okay? And I'll take care of you once it's ready. Alright, someone's typing something. Any last words, guys? Can you show me the market structures high slide? Absolutely. One second. This one? Thank you, Ken. This one? Alright, guys, I'm going to mute out. I'll close the room in 2 minutes so you guys could get the email and stuff of that nature. But thank you for joining, and I'll have some more to come in October and November every month. I believe the next thing I'm going to be doing are setups and fake outs, but I may change that up. Just keep posted by going to the website, our website, alpha7trading.com. And if you have any other questions, you can just email me at support@alpha7trading.com. All right, guys. Thank you. Have a good day, guys.